You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hey, everybody. Welcome to Talking Real Money, the radio show and podcast all in one. It's a radio show and then it becomes a podcast. And we're glad you're listening wherever you happen to be, and we want to help you manage money in whatever manner you need to manage it. We of course, want to help you manage it the right way, and we want to help you make the right decisions, the sensible ones, the ones that are best for you, not best for us, and certainly not best for those other idiots that are trying to manage your money really badly. 855-935-TALK is our phone number, 855-935-8255. So call in your questions. You can also send them in anytime at talkingrealmoney.com. Just go to the contact form, and we'll answer them on the show or on a future podcast. We're always trying to help. As a matter of fact, we now have a podcast 7 days a week. 7 days
I thought you were going to say 8 days a week. Okay, so 7.
It's kind of like having 20. 8 days a week just aren't happening.
Not going to go. So yeah, we want to help. So let's do that. What do you say?
Yeah, let's go to Jan right now, who's been waiting for quite some time. Jan, welcome to Talking Real Money.
Hope it's worth it.
Hi, thank you so much.
Jan.
Thank you.
You bet.
I plan to retire in about 15 months from the university, and I have a great pension. I'm trying to play catch up, so I've been shoveling money into my Roth through the university, which I can put in $19,500 a year maximum. So that's pretty much what I've been doing for my VIP. I also have a DCP that I've been trying to max out. I've been putting in probably $35,000 a year for a long time now. So my question is, I have a VIP through Vanguard, and then they switched it over to Fidelity, and then my DCP they switched it over to Voya this year. I don't know if that makes any difference. I also have just almost $100,000 in a separate account that I just kind of moved over with a financial planner from another company just because it was just kind of money that I couldn't put into these other two accounts. And I'm wondering, when I retire, do I have to or should I put all of these together or leave them separate and keep separate accounts, like with Fidelity, with Voya, and with this other company, or do you recommend putting it all together into one?
Well, let's go into this a little bit. First of all, I haven't seen the DCP, the deferred compensation lately.
Yeah.
All I was saying, Jan, was I haven't seen the option, so I don't know the fact that Voya is now the custodian, the operator of that plan.
Right.
I'd have to see the funds available. Which
well, it's you pick from 5 different things. I have about $250,000 in there, and it's been doing very well. Even I haven't been.
Well, that doesn't mean anything to me, by the way. I think that's great. I'm glad it's doing well. But let's go back to your first. So we'd be happy, by the way, to look at the plan to see how best to utilize the funds in there. We do that. For people already, some people know this by a service we have at 401411.com. 401, did I have that right, Don? Yeah, 401411.com.
Correct.
And you can send us the plan. We'll look at it. But let's go back to your original question. Like, should you have all these various accounts and blah, blah, blah? The answer is really no. I think people should have one IRA, one Roth, and then any other after-tax money. And here's why. For when you get to the place where you're going to need to start drawing money, it will be more confusing because you'll have various custodians and various amounts and how much you have to, when the government's going to start telling you it's 72, you have to start taking the money out. it's confusing. Number two, it's confusing in terms of your stock to bond ratio, what I own, what I don't own, all those things. That said, I don't know anything about your current advisor, so I'd have to see what they're doing.
I'm actually
before I did
looking
that.
right now. If you're using their retirement strategy funds, which are target date funds through the DCP.
Well, no, I think she's breaking it up among the various
because
asset
boy,
classes.
their retirement strategy funds are amazing.
Yeah, no, the
But
DCP has had some very good mutual funds.
I have it on a 2025.
She does. The 2025. Get this, Tom. Let me tell you what's in the 2025. I really like it. And you may not know this either. This thing is 50% U.S. stocks, 50% international in the equity portion of the portfolio. They overweight value.
Wow.
They add REITs. They have tips. They have
sounds pretty good.
Intermediate bonds. I mean, I'm telling you, it's at 0.15%.
That's very inexpensive. So
hang
that's
on with us.
fun.
Hang on with us for just a minute, though, because we'll continue. Because this is kind of complicated, but man, I'm telling you, this is a good fun. 855-935-TALK is our number. 855-935-8255. Give us a call.
Tom and Don are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
For your real life and real future, Tom and Don are talking real money.
All right, let's see if we can recap all of this. Oh, by the way, 855-935-TALK is our phone number, 855-935-8255. We're talking to Jan. Jan has a bunch of different things, deferred comp plans at work, and she's going to retire from public education
15 months.
In 15 months.
Yep.
Now, Jan, just one thing that stuck out of all the things you mentioned. You said you have an investment advisor?
Well, I kind of do. He was like a friend of a friend, and I didn't know what, I had some money from a previous job a long time ago that was in an account and a Lincoln fund, and I didn't know what to do with it. So I rolled it over with him. And
what did he put it into, by the way?
I couldn't even tell you.
What's the name of the firm? Do you know the name of his firm?
Thrivent.
Oh, Thrivent.
Yeah.
He's a life insurance salesman. He is not a financial planner. He's not an investment advisor. Thrivent is the old Lutheran Brotherhood.
Yeah, Lutheran Brotherhood.
He's an insurance and mutual fund salesperson. You need to get away from that person. The reason that stuck out is because when someone has a good investment advisor, a true investment advisor,
100% fiduciary,
those people help you answer all of these questions. If you have a good investment advisor, they're going to help you figure all this stuff out.
Well, and they would have said, for example,
he doesn't know the answer. Trust me.
No,
he doesn't know the answer. He's a salesman. He's a salesman.
But let's go back. Let's just go back. Just because what you said at the beginning is important, because you sort of did it as a throwaway line. You have a good pension, right? You mentioned that, correct?
I do. I have a very good pension.
Yep. And you're going to be getting Social Security, right?
Well, right. So I'm planning to have a pension. So I won't be able to. Okay. Right. And so basically, I just want to make sure that the money that I have in here, I don't have to take it out until I'm 72. Is that correct? Or take money out of it?
That's correct.
So I'm just trying to I'm trying to make as much money as I can.
You're smart. No, you're doing what you should be doing. Once
I retire, I can't put any more money in this, right?
Okay. A couple of things. One, the first thing is that DCP, I looked at the 2025 fund, and while I like the way they invest with overweighting value, that portfolio, for someone who's retiring in 15 months, is a little too aggressive. It's got a lot in stocks, and it's also got junk bonds in it, which makes me very uncomfortable. If you're going to stay in the DCP, I would suggest you move it to the 2020 fund.
And let me finish the thought here, because I'm going to argue with Don just a little bit. See, because where I was headed was pension plus Social Security is a number of amount of income. And when I hear you saying that I have a great pension and I'm getting Social Security, I heard you say I'm trying to make as much money as I can. This is sometimes, I think, saving as much money as you can.
You're right.
Totally
That's a
makes
better
sense.
term. Yeah.
Making as much because that gets my ears perked up. I don't know that you need to. This is part of a good advisor. Somebody should sit down with you and say, here's how much you're going to tell them. Here's how much income I want every month when I retire. Great. Pension's going to be this much. Social Security is going to be this much. And then what you need to draw from your other portfolio makes up the difference. If you're close to that today, I don't know why you would take risk you don't have to take. That's what I'm talking about. A good advisor should be working with you to determine, solve for that. Then the investment part becomes part of the overall plan, not I'm trying to make as much as I can. That's when people generally get in trouble.
That's going at it from the wrong direction. And now, one quick question: how much money is with Thrivent?
About $100,000.
Oh.
And then I have like $250,000 with DCP, and I have almost $400,000 with Fidelity, my VIP fund.
Okay. That Thrivent money should not be there anymore. That should be somewhere else. That should be at Fidelity. That should be at Vanguard. That should not be with this friend of a friend unless you just like making your friends money.
Or unless you're still a member of the Hood. I don't know. So.
I don't know what that means, but
I don't either. What did that
mean? The Lutheran Brotherhood. I'm sorry.
That was another bad dad joke. Oh,
sorry. Okay. Oh. All right, I'm going to be quiet for a few minutes now.
All right. So anyway, my suggestion: go to 2020 with your fund. Because, again, as Tom says, this is not about taking the most risk to make the most money. This is about preserving capital, too.
And I do think, again, 15 months from retirement, trying to figure out income, you should sit down with a 100% fiduciary advisor and come up with a plan now.
Go to talkingrealmoney.com/help. We have all kinds of tools and even suggestions as to people you might want to talk to, because you do need a plan. He's right. Okay?
Yeah, and I don't. Okay, thank you so much. I appreciate your help.
You're very welcome. Thank you.
All right,
and fire that Thrivent friend. That was a terrible joke.
I'm sorry.
It went. It went right over my head, and I've been working with you for years.
That's a good point. If you can't get it, then
I'm telling you, I usually
Jan.
get your jokes. The Hood. Okay.
Well, it just kind of worked for me.
I'm going to let it go. 855-935-TALK. You know, but I want to go back to this 2025 and 2020 fund because it's curious. The 2025 fund in this DCP has almost 7% junk bonds in it. High yield bonds.
We touched on this recently. This is one issue you're going to see more and more, because as U.S. government bonds pay so little, people running funds like this are going to say, we got to juice this up. We got to find a little yield here somewhere. We got to do something that's going to make some interest because the government's not paying you much. And this is problematic because those bonds act like stocks in times of crisis.
Yeah, it was just
guaranteed. It's happened.
Struck me strange that those are in there, that those are in the mix. But I understand why they are, but I don't think that the strategy makes sense, because let me explain something a little bit about high-yield corporate bonds. High-yield corporate bonds have that other moniker, junk bonds, for a good reason. They are only slightly less risky than the company's common stock. If a company gets into trouble, the first thing that will be their common stock holders. The second thing to go will be the junk bond holders. The secured debt people, the higher, the secured creditors and the like, they get preferential treatment. Junk bonds are junk bonds for a reason, because they tend to be companies that are having a little bit of trouble. I mean, a lot of trouble.
And if you don't believe me, go look at Vanguard's high-yield bond fund in 2008. It lost almost a quarter of its value that year.
Wow.
Yeah.
And
So that should
Vanguard's,
tell you
by the
everything
way,
you need to know.
Vanguard's is one of the very best quality junk bond funds out there. There are others that fared far worse, that have junkier junk in them and higher yields.
Tom and Don are talking real money.
There's a science to managing money. I call it financial physics, and you can get a free copy of my easy-to-read book, Financial Physics, at talkingrealmoney.com/free, or there's an interactive version available on Apple iBooks. It's called Financial Physics, that's spelled with an F, and you can get it free at talkingrealmoney.com/free or in the Apple bookstore.
Your guides to a really great financial future. Tom and Don are talking real money.
Trying to help you make the best decisions about your money because it's the fuel for your future. 855-935-TALK is our phone number. I'm Don. That's Tom. Forgot to introduce ourselves in the excitement over getting to the caller who was held over the break, or held over to another day if you're listening to the podcast. A whole day. It's kind of like, the taping of
That's
game
old.
shows. They do like 10 in a row, and they go, and so-and-so has been here since yesterday. Yeah, it was an hour ago. Come on. 855
seems a long time.
935 Talk. Kathy, you're up next. Welcome to Talking Real Money.
Hi there.
Hey.
So I wasn't listening earlier, so I hope that you didn't already talk
I'm sorry
about
then,
this.
Kathy, we can't talk to you. I'm sorry. If you don't listen to the whole show, we can't help you.
Actually, we don't know anyone who does listen to the whole show. so-
Unless, of course, you live in the hood.
Yeah.
I didn't get that one either.
I didn't. Yeah. Oh,
All
Kathy
right,
didn't get
well,
it either.
God,
All right,
it's
Kathy,
killing
what's
me
up?
here.
What's up?
Okay, so I recently took one of those retirements because everything that's going on with COVID and that, and with some of after funding my Roth to the total allowable of $7,000, I want some place to put the extra money. It's not that much; it's like $15,000 or something, but so normally I've only funded the tax places wherever I was saving, for retirement places is where I've normally put my money. And is there a place that you can put money to make more than the savings account, but have flexibility that if you want to take it out, that it doesn't have the penalties? Or do I just have to take the whatever percentage at the savings account? Because I'm not sure what we might want to do something around the house since we have time now and that, do some things that you never did before. But in case it's like normal where I never do anything, I don't want it just sitting there. So is there a happy medium if you don't know what you're going to do? Okay.
No. I mean, the reality is, yes, but you're taking a modicum of risk to do it. That's the trade-off, right? Because we talked about this yesterday, last hour. And this is a mutual fund that Vanguard operates, the Vanguard Short-Term Investment Grade Bond Fund. Don't write it down because I'm going to give you the ticker.
Because he likes giving the ticker because he gets to use the military
phonetic alphabet.
The military phonetic alphabet.
V is in
makes
Victor.
him feel like he's participating somehow in the.
Thank you.
Yeah, so we can thank him for his service.
Oh, stop it. V as in Victor, F as in Foxtrot. VF.
Thank you.
S as in Sierra. T as in Tango. X, I don't even have to look it up, as in X-ray. VFSTX.
You finally memorized one.
I'm one of them. So that's still paying a little over 2% a year. It's paying a little bit more. It owns securities of companies that need to borrow money for various reasons. These are well thought of companies, solid companies that generally pay you back. It's a mutual fund that owns thousands of them. So I've used this for a long, long time, I think over 20 years. It's my friend Paul Merriman recommended it. And it's a way to make a little bit more, keep up with inflation, because you're not going to do that in a savings account.
That makes sense?
And so it makes about 2%, and then there's not a penalty, like if I decide.
Nope. The only potential penalty
that I want to take.
Let's say hypothetically that interest rates spike up to 2% next week, the Treasury rate. You might lose a few $100s of your investment because the value will go down. So there's a fluctuating value. That's the price you pay for that higher yield, because there's no totally safe place you can go in this world, period. Well, no, there isn't, that can get you 2%. Just doesn't exist.
No, sorry. That's completely safe.
So you're accepting some
You're
risk.
getting paid a little bit more for the volatility that exists. And every once in a while, I think that fund did lose a little bit of 1 month last year. Anyway, so it happens in short periods of time. That's what I'd recommend, just to make a little bit, but still have the money available when you need it.
Thanks for the call, Kathy. We truly appreciate it. Take care. And, if you don't want to do anything, just don't do anything. You're retired now. 855-935-8255 is the phone number. We'll be back momentarily.
Tom and Don are talking real money.
Everybody needs help with their money now and again, and if you need more help than we can give in the course of this podcast or show, set up an appointment with one of our advisors for a free actual meeting with no obligation and no high-pressure sales pitch. Just go to vestory.com, that's vestory.com, or call 800-386-3004.
Reality radio for a really great future. We're talking real money.
I looked up, just out of curiosity, the Thrivent mutual funds.
Yeah.
And I looked at their 60/40 target date fund, which is called the Thrivent Moderate Allocation Fund.
Makes sense.
Okay. And I looked at the costs. Up front, 4.5% commission, right off the top. That means your investment is
Your
reduced.
100,000 just went to 95.5.
95.5. And then what does Vanguard charge on their target date funds? About
12 basis points.
0.12, something like that. Yeah. They charge 1.04% for a balanced fund, basically.
And I don't. Anybody can go make a living. That's a lot of money, by the way, if you're playing along from home. Anybody can go make a living. Here's the part I don't like about it. They do it through the church.
Yeah, they do.
It's affinity sales. And that doesn't mean, by the way, everybody you work with from your church is a bad person.
No.
But generally, this is what happens. I met the guy there, and he's
it's an affinity sale, and they're taking advantage of that.
Yeah, they are, because they're assuming you don't know better than the fact that you don't have to pay that much money to others to take care of your money. That I don't like.
855-935-TALK is our number. Give us a call. We want to help you deal with your money better than before. Jay.
Dave.
Oh, my gosh. I got out of line. I went the wrong way.
Dave's
Dave,
here.
Welcome to Talking Real Money. Dave?
Hey,
Dave.
Hey, yeah. Go, man.
Can you hear me?
Kind of.
Yes.
Yeah, that's good. Yes.
Okay. Like your previous caller, I'm in the DCP plan and also a TRS3 plan. I'm a teacher.
Yes.
And I've been saving quite a bit. I'm set up in the 2030 retirement fund, and between those two accounts, I've got a little over $1 million. My question for you, though, is this: is when I started teaching back in the early 1990s, before I knew anything, I had a guy came to my school and was talking about financial plans. And what I ended up doing I ended up buying a Kemper annuity. And I had that for probably 10 years until I realized that I wasn't really buying shares. I was buying units, and I was buying things and paying a front-loaded cost. So I ended up investing about $57,000 in that, and then I stopped and just left it alone. Well, today that account's worth $235,000. And my question for you guys is, should I just leave it alone, or should I roll it into something else?
Okay, I want to get clarity here.
Okay.
Does Kemper still have annuities?
I don't think so.
Who's this with now? Is it?
It's through insurance services. I think it's changed a couple of times.
Yeah, because Kemper's
Zurich.
been bought out multiple times.
Zurich.
By Zurich, that's it. It was Zurich.
Yeah, that's
yes,
it.
Yes.
Yeah,
it was Zurich Kemper for a while, and then it was Zurich. And this, what is this, a fixed rate annuity, or is this a variable annuity?
I think it's variable.
Okay, so it has
gotta be to go
a
from
mutual
the-
fund
that
component.
growth, yeah.
And you bought it when?
Well, I think I stopped contributing maybe in the 2007 or something like that, 2008. So I ended up I've put $57,000 into it, and I've stopped long ago. And it's worth
Okay. All right. Well, that
$235.
makes sense over that period of time because you had a heck of a great market, so it must have some equity exposure. So that makes sense. Now, a couple of problems with annuities. I'll just tell you what you face down the road. You get tax deferral now, but unlike regular mutual funds that get capital gains, tax advantage funds, or a total market fund, when you take the money out of an annuity, you're going to pay taxes on it at your income bracket, which is higher than the capital gains rate. And the fees internally that they draw off of what I'm saying is if you had that money in a similarly risky portfolio outside of the annuity, you would have had even more money and it would have had a better tax effect at the end. Treatment at the end.
Yeah. So the question is, though, what you can do today with that money. That's the part that we get into the specifics. Probably have to have somebody look at that because I'm not sure that it's inside that plan.
Well, no.
What your rights are.
It sounds like it's out. Was it outside of plan, Jay? Hang on with me a minute, Jay. I want to come back to you after the break because I really want to figure this out. You may be able to do an exchange into a less expensive, maybe even a better annuity.
Tom and Don are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
For your real life and real future, Tom and Don are talking real money.
You know, a break got right in our way when we were talking to Jay. And Jay, the question is that Kemper, Zurich, whatever it is, annuity, is that in a plan, in a retirement plan, or outside of a retirement plan?
I guess it's out. I mean, it's outside of a retirement plan. As a school teacher at that time, I think it is now that you're allowed. Is it like a 503B or something like that? I don't know if that's what it is.
403B. That's what I'm saying.
403B, then that is in a plan. If it's in a 403B, then that is in a plan. And at this point, unless one of the cool things you may be able to do, your 403B may offer other mutual funds. And you could move out of that into another mutual fund without incurring any penalties or tax problems, which might not be a bad idea.
Now, I would suggest you have an advisor look at this. I looked at one for my brother a number of years ago, and he could not get out. He was stuck in it. So, but I'd have somebody look at that.
It's not great, but it's okay. It's okay. Thanks for the call, Jay. We really appreciate it. And Dave came back. So, Dave, welcome to Talking Real Money.
Hi, Dave.
Hi, guys. Let me take you off speakerphone.
Hey.
So last week and this week you've been mentioning VFSTX, and I'd like you to take a couple of moments and compare that to VBTLX as solutions to give that bond balance to VTWAX.
Can you do that in the phonetic alphabet, please?
No, he's talking about the total bond
MOUSE.
versus the short-term investment grade. No. You don't have to do it. Two completely different funds. So the VBTLX, the Vanguard Total Bond Fund, is designed to look like kind of the aggregate bond index, if you will, of the United States. It has some treasuries in it.
Some longer term,
decreasing,
some shorter
term. Yeah, decreasing amount, by the way, interestingly enough. But treasuries, got some corporates in it, and it's yielding a higher yield than what you would get from the VFSTX, which is a short-term corporate bond fund designed for short-term money, in my mind, and not to be part of a bigger picture portfolio. If I was saving for the future, for retirement, I would use a split between the VTWAX and the VBTLX. I would not have the VFST. Is that enough symbols? The VFSTX in there as part of that.
Make sense?
Okay, so So the VF FTX for
the short
term is an option to the savings account. Right. The VDTLX is long term to balance out your VQX.
Correct.
You hit the home run there, Dave. Well done. Yep.
Thanks, guys.
Right. No, I said you hit it. Perfect.
Thanks very much. You, and up next, we have Sandra. Sandra, welcome to Talking Real Money.
Yeah, hi. My husband has retired and is 70 years old and has $100,000 in a old Mariners account, or Mariners, when he used to work for the Mariners. My understanding is now he cannot take anything from that until he's 72. And then after that...
No, he's not required to take anything.
He's required to at 72, but he can take it out prior.
He's required. Oh, he can take it out prior. So now our question is, what's the best fund or what's the best thing to do with this? I just don't want to take whatever he's going to take out of it, probably, if he's going to wait till 72.
If I were him... Yeah. No, this is very simple. He used to work with the Mariners. I would put it all on the Mariners to win the World Series in 2021. Every dime.
Yeah.
No, I'm kidding. That's a bad joke. That's better than the last joke.
Hey, she laughed.
That's better than the last joke.
I don't know if she was just humoring you or if that was a legit laugh. No, do you have other retirement assets, Sandra, you and your husband?
Well, we do own a home, yes. We do.
No, but do you have any other investments, any other retirement investments? 401ks?
No, we really don't. No,
and that's it.
That's 401k that he has. Yeah, that's it.
Yeah.
And you have no other IRAs or brokerage accounts or any of that kind of stuff?
Well, he did that one time where you said you could do $6,500 or $7,000 for the tax break. He did that in IRA.
Where did he do that? Where did he do the IRA account?
In a BECU. It's a credit union.
Okay, that's not the best spot to do it. What? A couple of things, because to really get to the meat of where you should go can take a little time figuring out what you want to do with it and all that stuff. But I think a good place to start is to go to TalkingRealMoney.com, take our risk quiz, determine what you and your husband's risk tolerance is. Then go to someplace like Vanguard, move that Roth IRA over there, or that regular IRA, move it over there, get a portfolio that you could use a target date fund
or balanced index fund,
or the balanced index fund,
either one,
and try to base it on your risk tolerance. Don't be more aggressive than you can stand being or need to be, but you may need to be a little bit more aggressive because you don't have a lot of money going into retirement. So it's really important that you treat that properly. So go to TalkingRealMoney.com and take the risk quiz, and thanks so much for the call. Okay, we got to run. Thank you for calling, and
thank you.
Okay, Tom was doing the thing. I'm just following. All right, Tom.
We have the other Tom.
We have one more Tom before we run out of time. Tom.
Hello. Hey.
Yes, hello. Hi, Don.
What's up?
I got a short-term treasury bond fund with Vanguard, VFIRX. I just wondering what I'm making. I don't see it making anything. It's an inheritance. I just going to retire in like 3 years. I have a very good retirement plan and Roth IRA.
Well, how much do you have in there?
That is the treasury fund. So, yes, that is a short-term treasury fund.
I'll bet the yield is about
1.2.
Oh, a point. Pardon me. I just made you a lot of money.
1.2.
Oh,
1.2.
Oh, okay, 1.2.
Yeah.
Yeah, that's how much of your money is in that? What's the purpose of the inheritance? All those things should go into looking at whether or not you'd move out of that fund into something more aggressive.
Well, that doesn't. 1.2 isn't a lot. I'd like to see over 2. It's an inheritance. It's totally extra money. I just got it last year, and
but you want to keep it safe. You want to keep it reasonably safe. Is that what you're saying?
Yeah, during these times with this COVID and all this, I'd like to keep it safe for now. But I don't.
You could go. I would go total bond. I'd go total bond.
Okay.
VBTLX.
Can I say something?
Go ahead.
What do you mean during these times?
Oh, yeah, thank you.
We always have uncertain times. The point is this money you need in the not-too-distant future to live on? If yes, keep it safe.
No.
Or
do
you just
have money? I have a good Roth IRA and a
what do you want
401k
this money to do for you? What do you want this money to do for you down the road into the future?
maybe just buy a summer vacation house in like 3 years.
Okay, so
when
it's
I
play
retire.
money.
Play money, pretty much. Yeah.
Then
Yeah,
you
I'd love
want
to
something with
put in
some
and making a lot of
equities
money.
and some stocks.
What we think you want, what we would tell you if we were your advisor, what we would probably tell you is you can't time the market. You can't pick the best time to go in. If you're thinking, yeah, eventually when everything settles down, I'm going to go get myself a nice equity fund and make some money with this money. That's not going to happen. That's why we recommend a total market fund, because there are segments of the market, like a global fund, there are segments of the global market that haven't done well lately and segments that have done well lately. And by buying them all, you get the areas that have been stinkers and the areas that have been really great. Like, you know, the only part of the economy that's really been great is about 5 stocks.
Yep.
They're up 50% this year. The rest of the market's
if
pretty
you
much
buy
stinker.
the total world stock index, you get all those stinkers too, and no one rings a bell and says, "Well, okay, but safer right now." That's the issue. Yeah,
Ain't
just
no
go
such
with a
thing.
short-term bond fund, but safer right now implies you believe you're going to know when it's the right time to get back in. And I'm telling you, as someone with a lot of experience, you won't
Tom
know.
and Don are talking real money.
Before you end up buying a financial product that you'll regret later, either call us on the podcast or the show, or if you need a little more time, that's why we offer free meetings with our fiduciary advisors at Vestory with no cost, no obligation, and no high-pressure sales pitch, I promise. Just give us a call at 800-386-3004, or better yet, just set up an appointment at vestory.com, VESTORY.com.
Your guides to a really great financial future. Tom and Don are talking real money.
We always like to think that times like these are different. Well, times like these are times like these. And, you know, we have COVID, we have a presidential election, but the funny thing is, long term, these things are quickly forgotten. And that's why we're doing a class on presidential elections and stocks coming up on the 21st. Register right now at TalkingRealMoney.com under the events thing.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.